I wanted to cover some of the questions that I received the most of the times, how to interpret the credit report, and how to structure the file and relationship between the DTI and the credit. So I want to go over a little bit in depth of how to structure the credit and how to engineer so the file becomes denial to approval. So let's dive in. So before we begin, I want to cover the mechanism and talk about the return on investment, because this is the highest leverage that you can take and earn the most within the 20 minutes of the training. So moving the bar from 640 to 660 can drop the rate and the LLP enough to change the monthly payment meaningfully. And sometimes it's a difference between the approval and the decline. So rapid rescore that we have turns around within 3 to 5 days, faster than waiting on the bureau's update. So you pay $125 per trade line, but at the same time, we have a VantageScore 4.0 now makes the difference to all the people who has a lower credit scores. Every one of those is a potential client who used to walk away. So how is this credit score is built? Think of a recipe with 5 different ingredients, and they are not equal. Payment history is a 35%, and it's the biggest. And the first 30-day late can drop a score to 50 to 100 points. So amount owed, which is really the asset utilization, is about 30%, and that's your fastest leverage. And you'll spend real time on it, asking the borrower to pay down or to keep the funds as is. Length of the history is about 15%, and new credit and inquiry 10%, and credit mix at least 10%. So you may wonder, is it safe to pull multiple credit reports within 3 to 5 days or within 30 days? Answer can be yes or no, depending which category this borrower is sitting at. If we are dealing with a borrower who's telling me that they're having 690 to 710, we should educate the borrower so that they don't shop around. But at the same time, FICO score 760 to 800, they can shop around anytime and make decisions anytime, anywhere. So here's a key point. Payment history and the utilization together are 65% of the score. And utilization is the only one you can actually move within this week. So that's where the structure, begins. There's one flag though. Don't let clients close old cards. This shortens their leverage and the average age of the account that hurts the 2 factors at once. So when we talk about the model trap, this is the most important slide that I want you to cover. The score your client sees on their phone app is not the score mortgage reports pull. Mortgage uses older models, Experience FICO 2, Experience FICO 5, or TransUnion FICO 4. These are showing on the credit reports. These were built around 2009-ish. And what does it mean? When Experian number boost, connecting to utilities, the cell phone bills, or using the non-traditional trade lines does not move your credit mortgage score, determining credit score. So neither does the FICO 8 or 9 on their phone apps or VantageScore on the Credit Karma. So understanding where the numbers are coming from can help you which direction we're going to take. So when you hear something like, can I add my utility bills? Can I add my lease payment, lease agreements to the score? Will it impact? It won't. It will help the trade line histories, which we'll go over later today, but you'll be very unhappy and meet with unhappy borrower if you indirect the borrower and then end up repulling the credit. The legitimate alternative data path is a VantageScore 4.0, which we'll get there. So when we talk about the determining credit score, we always say, which do we pick? What can we pick as a qualifier of the 3 bureau scores? We're not taking the average, we're choosing the middle. So in our example, John, 3 score was 742, 718, and 705, and his middle score is 718. Mary, on the other hand, is 688, 699, and 672. So her middle score is 688. So with 2 borrowers, we use the lower of the 2 middles. So this file qualifies at 688. Mary drags it down. Now the structure comes in. If Mary's income isn't needed to hit the DTI, so you can drop her completely on the loan app and qualify on John's 718. So that one decision can move you a full pricing tier. So this actually will help you where the credit and DTI connect. So regards to this utilization optimization, this is the number one lever that you can go in specific with your borrowers. First, pay below the threshold, not to zero. Keep utilization under 30% overall per card, under 10%. Squeeze is the last point. So if you want to get to the 760 plus, this is where you want to begin conversation with. Interestingly, a lot of buyers pay off their balance to zero at the end of the month, but each credit trade lines have a statement balances, statement date, reporting date different. So notoriously, American Express has every 8th. Chase card has every 16th. Bank of America every 3rd. Every card can score differently, slightly lower or higher. So even though you consult with a client who is telling you they pay off their debt every single month, you shouldn't rely your decision based on that. You can state that information in the email. So when the credit report is pulled and wrong information is showing on there, at least you have a physical, tangible benefit, line to counter that, leading the borrower to pay off that balance shown on the credit report. And second, most loan officers miss this. The statement date showing on there, not the due date, right? So if you end up paying off the credit card, make sure you receive the statement balances as well. And make sure you update statement balance amount reflecting on the new credit report. We can do that by refreshing the credit. So this is a credit. This is a trick that you can play around to control the closing cost at the end of the day. Soft pull increases the lower utilization with no new inquiry and new age drag. So play multiple options that we currently have. So what do I mean by this is you can use one trade line hard pull, or you can use two merge score. But at the same time, if you need to make a decision of the one report, VantageScore and the FICO score options both can be worked at the same time. But try merge always. So let's talk about rapid rescore. So we had incidents talking about this, and loan officers didn't know how to order this, how to maneuver this. Rapid rescore is a paid service through credit vendors like CTI that updates the trade line in 3 to 5 business days instead of waiting for the usual 45, 60 days from the bureau. So the flow is very simple. Number one, identify the lever, pay down, miss report correction, or a paid collection, and have the client act and get proof and submit to the vendor and repull in a few days. Then you rerun the DU and LP based on the new credit score. But you need to set up new expectations. Use it for paydowns is a clear tier, fixing a genuine report error, naming error, or information error reflect the payoff count. Do not expect it to remove when you run the rapid rescore. There's an option where you update the information, but also there's an option where you click X button and trade line gets removed. Do not do that unless you have specific documentation proving that this is valid. These removing the active and accurate derogatories seems like you are winning the dispute, but those are difficult processes. These are sometimes taking more than 6 days. And always have the proof in hand before you order it, so you don't have to use, and pay and wait for unnecessary delays. And inquiries and the new credit disciplines. Inquiries, as I told before, is only considering 10% of the credit scores, but new credit during the process can blow up the approval file to a denial. This is a discipline that you have to set in correctly, especially dealing with rate shoppers. Tell the client to rate shop within the window, multiple mortgage or auto pull within the 14 to 45 days counting can be considered as one inquiry. Cluster it, don't spread it, meaning if you must shop around, shop on the June 30th from 9 a.m. to 12, 9 a.m. to 1 p.m. You give them an expectation so that when this person returns, you can work from where you left off. So for example, there are a lot of clients who freeze their account during the process. A new car loan in the middle of the application may change the DTI and score both at the same time. So this is a practical killer that I see when I was doing the processing meeting last couple of weeks. Many lenders do a soft repull before the day closing called refresh. So new trade line that shows up can trigger underwriting once again. So coach the borrowers and explicitly make sure that there's no credit, no big purchases until we say it's funded and closed. So one upside tool is adding the client as an authorized user on a seasoned low utilization card can lift a very thin file if the lender counts AU as a trade lines. And this is a reference slide. You don't have to memorize all these, but for the QM purposes, Chapter 7 considers for the 4 years and foreclosure for the 7 years. FHA, VA are shorter. But if you look into the column, non-QM compresses all of this drastically. Sometimes 1 day out of a foreclosure is available. So this is a takeaway. And client has 18 months out of a foreclosure. Is that for the conventional, but live for the non-QM today. So if you only know the agency windows and you unwantedly reject the client. So if you know all the windows, you route them into the new loan product. Route them, don't reject. That's the theme that I want to cover on today's training. And you always verify with a current investor matrix. Running loan sifter can be one, but sometimes the best case lender or incident may not occur, may not apply all the time. So this came up sometime last week. What happens when we are dealing with the disputed trade lines? So it seems like it's a landmine that pops up in the worst possible time after the client thinks that they are approved or willing to move on. So active dispute flags automating underwriting system to ignore the trade line. So when you run the DU and LP and come back with a refer or invalid result, many clients, many loan officers immediately stop the process and say that it's not available, it's denied. But when we apply this credit repair tool and rapid rescore tool, this underwriting can overcome this dispute, either to remove or resolved before closing. So conditional loan approval can come out. So my recommendation today is to pull the credit early and then scan for the dispute marks, scroll it down and review what the status is all about. And then when it says something like consumer disputed this account, then have the client call and remove the dispute before you run AUS. When the AUS is ran and FICO case number is assigned, it's sometimes too late. We have to repull the credit. Then repull or rapid rescore and then submit with a clean intention, clean AUS approval certificate. So this is a hard compliance line. So because we run broker, non-del, and full del right now, sometimes you have to intentionally cancel the file. You never coach a client to file to frivolous dispute. That's a FACRA and fraud exposure to all of us, right? So make sure you differentiate that there's a purpose of an ERP, okay? When you register a file to ERP, go through prospect applicant, not through submission channel. There are still some of us start a file processing from submission page. If you end up pulling the credit report using the e-sign consent and borrower's consent dated that date, we may end up pulling the credit report once again. And I'll go over in detail when the problems come up. We had one case that is causing issue right now. So always begin with a prospect applicant with borrower's email, so we don't have to go back. So let's talk about non-traditional trade lines. So when we talk about non-QM, you may say, hey, Peter, there was a bureau, there was a lender, there was a credit agency letting us know that we can apply the loan without credit score, credit trade lines. But why are you telling me upfront that this is available, this is not available, right? So this can be a very tactical play. So this is a different problem. How about, and what about a client with no score at all, right? Or a thin file, a borrower who were using cash only for the last 7 years. So this is where non-traditional credit comes in. A client who filed bankruptcy within 2 to 4 years can come in. And I want to be very precise. The non-traditional trade line credit does not raise a score. When there is no score, you don't raise it. You build a credit profile from scratch. So you help them to qualify with second tier or third tier non-QM products. So who needs it? Recent immigrants, cash-based earners, young first-time buyers, newly graduate borrowers, people the bureaus can score, right? So what is this? Verify payment patterns used on the manual underwriting is the key term. Establishing creditworthiness is the key. So where does it work? FHA, Fannie, Freddie manual underwriting or a Vantage 4.0 can come in, and we'll hit that next. So let's get into it. What counts as a non-traditional credit trade lines? FHA manual underwriting generally wants a housing source, the rental payments, plus additional references like utility bills, water bills, and housing carries the most weight, right? And tier 1 is a housing rental lease documented by the 12 months of verification of rent or 12 months cancel checks. Tier 2 is the core utilities, electric, gas, water, and also tier 2, cell phones, internet, insurance, tuitions, childcare, you name it. You'll be amazed how many options we can. Each with a 12 months history with a reference letter or statement can work. So when we talk to the borrower, housing payment history is a king. When you fill in the calyx point, I'm not going to name, but some of us do not provide the current lease agreement when we are dealing with first-time home buyers submitting a file. We always go back and forth and kill 2 to 3 days for no reason. Make sure you complete the 1003. What I mean by that is to receive the lease agreement, verify on the bank statement so that you don't have to worry about that X factor. So what if the rent back wasn't by cash or wasn't by check or ACH? When there's no history, let's say we were exchanging cash with a tenant and the landlord, but that's where the problems come up, right? So verify the exact source. Count on your current investor's manual matrices, meaning when you have a cash exchange, replace it immediately with a verification of rent, okay? Documentation is where these files are can win or lose. So you shouldn't have any gaps. You shouldn't use any cash. You can, but your options are somewhat limited. 13, 14 loan product will shrink into 1 or 2. And what if you accidentally quote the rate at 6.875 with 2% yield spread, but end up giving them 6.875 with margin, no margin, a par rate, or 7% with discount points? Something like that can happen within our system. So again, no cash, no gaps. Cash paid rent is, just treat them as a nearly impossible to document. So rent free is a keyword that I want to share when you hear cash exchange. Okay. You can capture all the future buyers early and set up their expectation and documentations now so that you can put 20-day, 30-day escrow. Let's talk about VantageScore. None of us actually use VantageScore to qualify, but we have multiple 500, 600 credit score applicants, right? So let's cover this briefly. This is the headline that PennyMac announced last week. Right after our Tuesday meeting, that later Tuesday night, they released this VantageScore availabilities. So we don't have to go through UWM pricing anymore. If you hit the 80% LTV, you can basically change the dynamic completely. Vantage 4.0 is live with conforming loans and reads exactly the alternative data that FICO 2, 4, or 5 used to ignore. So Fannie Mae approved, Freddie Mac approved both of them. So what it means by you is approved programs within PennyMac, LTV 80% or lesser, 20% down or more, that you choose between Classic FICO and VantageScore 4.0 on the tri-merge. So the thing is, your client sees on their phone app, the VantageScore is finally usable factors. Alternative data that does nothing on the FICO scores now feed into VantageScore 4.0. So that's a bridge that we've been building. So what's the difference? Let's put them side by side and focus on the difference that matters to our client base. Rent, utility, and telephone bills, largely ignored by the regular classical FICO model, is now directly incorporated by the VantageScore. Medical collections, this was weighting heavily on the FICO model, but now it's completely excluded on the VantageScore. Trended behavior, VantageScore rewards on a client actively paying debt down over the last 24 months, whether it was thin or short story, often unscorable on the FICO score, but VantageScore can, they say, up to 33 million people in the United States. So look at those 4 pipelines and profiles. Rent payers, immigrant with thin credit profiles, medical collections who are having a hard time paying time in dues, disciplined paydowns. That is the first-time home buyers we see every single week, right? So the same borrower can score meaningfully different with a higher score on the VantageScore. So if you haven't done it, log into CTI and select the VantageScore and pull it out. You don't have to, pay. And if you have any questions or concern about this process, reach out to Brenda. Or Brenda, maybe we can create a short video of how to pull the VantageScore from CTI. VantageScore, so how do you actually use it? So make the routine a habit in papers. So step 1 is to identify the profile when you see something like, or hear something like higher rent payment, someone who is paying $4,000 to $6,000 usually fits into this category, who has medical collection, who intentionally didn't pay all the payments due during pandemic, actively paying down the debt, who has utilization percentage at 80 or 90%, can be the applicants. And compare both scores, FICO and the VantageScore, and run the pricing within the PennyMac and route the file to them and submit. So there's nothing, that's, new. We already knew about this back in April. Now we have actual lenders who can accept these files. So we should give it a try. I want to highlight on PennyMac product. PennyMac, when you run the pricing within their portal, they're going to give you the Power Plus and the Power. Power is a full deal like we do. And Power Plus is like a mini correspondent with we don't do. So when you receive an email notification saying that PennyMac is paying for the credit report fees, that doesn't apply to us. So agency conventional conforming only, 80% max LTV, primary residence, and compare both options. So this is a checklist that I want to cover today. Is the conforming conventional, Fannie or Freddie, or lender live VantageScore or approved for it? Scenario meet the lender's overlay, LTV occupancy, and the score is being pulled so you can compare. So we have an option now. As we have multiple cash out refinances to Fannie Mae with 400, 500 credit scores, right? Use this as a tool. Let's talk about the credit on the non-QM. So a quick non-QM lens before we wrap up today. So non-QM prices in FICO band, the crossing from 680 to 700 can move the rate and impact the maximum LTV. So major event in months, not in years. Self-employed clients don't need the 24 months of employment history. As long as we can document the 12 months of a self-employment, then we can approve the loan conditionally. DSCR cares less about the score. You'll be surprised. We have a 620 credit score. We just saved the deal from NMSI. We pre-qualified at 660, 661, I think. And we pulled the credit right before the submission and it came in at 650. And then we routed back to the lender and then saved the deal. So those investors, loans lean on the property's cash flow. And the FICO sets the pricing tier, not the core approval, okay? Because that's a perfect handoff to season and the approvals. So I want you to have a better understanding and the relationship of the DTI and the DSCR and how to pivot within the DSCR, within the non-QM. So I started a loan with a bank statement loan, converting it to DSCR. I started with a bank statement loan and adding bank statement loan income with asset depletion income. I started with W-2 income, but adding asset depletion on it. I started with W-2 income, but completely removing it and end up with asset depletion. How and why is all in the underwriting guidelines. And we, Brenda, Sydney, and I are available to answer any questions. So we can help you to plug and play all these feasible options that we have currently. So this is the one-page model that I want to share. Every credit file falls into one of the 4 buckets. Pull the tri-merge and find the mid-score, low score, or thin file. Go to the non-traditional credit for the manual underwriting or VantageScore. And when the score sits near at the tier line, utilization pay down plus rapid rescore can apply. And lastly, dispute flags the presence and loan approval. Remove them before you run the US. Recent major derogatory, route them to non-QM. Don't even think about the QM options. So drill this until you somehow feel it, memorize it. When a file lands on your desk, you should immediately know within seconds which bucket it's in and what the play is. So let's apply, right? I'll briefly go over the 3 possible scenarios, and you can tell whether this fits in or not. File 1, a recent graduate with 2 years of a clean rent history, no medical histories, only 1 credit card. So I would rather put this person into PennyMac's pricing using VantageScore 4.0 and apply with a conforming with a 20% down. Second file, 715 mid-score. So the card utilization is about 85%. This person surprisingly wants to apply for the loan when the utilization is to the T. So don't discourage the borrower. My suggestion is to target the pay down using under 30%. If it's a purchase file, instead of increasing the down payment portion, use a portion of the down payment or paying down the debt and apply 3% down or only 5% down. If it's a refinance file, use the cash out proceeds to pay down at the refinance at the close of escrow. So rapid rescore can be applied as well. We run the AUS using the new DTI for the better tier. Third file, a strong income, foreclosure completed 18 months ago. My suggestion would be, don't even consider the agency loans. Don't even consider the QM options, but live for the non-QM right there. Priced by the FICO score and the LTV and the document with the housing event. And when you see the pattern, then you can run the pricing and the quote right away. So this is my takeaway. We had a lot of denials, a lot of rejections, but thankfully I was able to capture these scenarios. And thanks for reaching out to me directly. We were able to save some of the critical purchase deals. Don't reject. That's what I want to provide today. That's a takeaway for today. We used to use FICO score 2, 4, and 5. We were aware of rapid rescore using the Experian Boost. We were aware of all these, soft pull, hard pull options. But I want to focus today on the non-traditional credit lines, that profile that doesn't have any credit score or that cannot apply, can have another set of eyes using the VantageScore 4.0. Using PennyMac and UWM. I'm not talking about UWM today because comparably pricing is significantly inferior than PennyMac's. PennyMac allows us to pull and use both as a determining factors and use the better one. And a lot of us use a stated income, stated asset, stated credit scores to run the pricing, right? But don't promise. When you send out an email in writing, make sure you leave a line saying that these pricing were based on June 30th at 9:30 a.m. using XYZ. So when these XYZs change, we're subject to change, rate, term, fee, all can subject to change. If you have that in writing, then none of them will surprise you in the middle of nowhere.